Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Paul Moore. Hi, Paul.
Hey, Mike, man, it's great to see you again. Thank you for having me on the show.
Likewise, great to see you on Zoom. In this day and age, it's all on Zoom. And
that's right. It feels like it.
Yeah, but we do connect in person. So we're back to traveling, and hopefully we'll see you at the next CG Mastermind or one of the other events.
Yes, sir.
How have you been? What's new and exciting in the world of Paul?
What's new, exciting in my world? Well, we're, raising money for our fund. We're exploring a few new asset classes. And I think maybe more importantly, we're thinking through how to pivot based on the uncertainty in the economy. I heard a really good webinar. It's been some months ago from Origin, talking about why their fund is doing first lien position debt. And I would, and the logic behind it, it was really more like preferred equity. It looked more like preferred equity to me, at least. And it just really reminded me, at times like this, there's a lot of companies scrambling who are very worthy of getting, CMBS or other loans that might not qualify right now, or they might not get those loans. And so we see an opportunity here. What do you think?
It's a great thought process. So first lien debt is something that we like to do. Of course, it's a conservative, defensive investment strategy. If you can get quality deal flow and you can price it to the point where you need to price. So we still do first lien debt today. We did it before. We continue to do it. Mm-hmm. The only good news, or sort of theoretically the better news, is that you can push the rates up. For years, the whole space was getting flooded with a lot of institutional dollars, and the rates have come down quite a bit. And now they're beginning to climb. So if you are thinking to provide first lien debt, in general, you are in a position of power. You could raise rates. So whatever you were thinking before, now you could do more. With safety of the first lien position and good underwriting, I think it's a generally pretty good strategy into a highly uncertain market.
Yeah, I think so too. And I think what it does is it provides, especially the preferred equity, which I'll call it similar in a sense. It provides some, real safety for a conservative cash flowing fund in times where it's not real clear where things are going. I just talked to somebody, an investor in Sacramento 30 minutes ago, who said that, Meta, Facebook had laid off 11,000 people in Sacramento. At the same time, they're building apartments all over town. Of course, we all know that they've been flooded with people from the Bay Area for years. Well, I don't know what's going to happen there. It's hard to say. I bet they won't be able to continue with the rent growth they've seen over the last 4 years. I don't know.
Well, that's a great point. So the layoffs is the desired outcome of the Fed policy. That's exactly what they're trying to do, right? They need to slow down the economy. They need to see layoffs. And tech companies are generally one of the early folks that let folks go because they're highly sensitive to the interest rate.
Right.
So the fact that we're seeing substantial layoffs is actually theoretically good news for the economy. It should slow down inflation, right?
Right.
As far as the building projects in layoffs in the same area, well, for those developers, it's not a welcome news because the incomes are going to take a beating, and the Class A apartments they're going to build, they may not be able to get target rents. So the Class A ground up construction projects look pretty speculative to me. So just provided two comments on two thoughts here. And back to the preferred equity. I happen to agree with you. The preferred equity is a great opportunity to participate in this market where you can't. So let's just take a step back and break up capital stack, right? Senior debt is the safest part of the investment. After that, typically, unless there's a mezzanine debt, if there's no mezzanine debt, then preferred equity is behind the first lien debt. And if you are not participating in the first lien debt because a bank is, then the next safest position to be is in the preferred. And as you know, we've been doing a whole bunch of deals with the preferred and common for multiple reasons. I certainly love the strategy because preferred provides greater safety. And this is really important. Also, depending on the deal structure, preferred can actually get yield. Well, the common gets no yield. All the yield goes to preferred. And that's a way to generate some return, some cash flow in this market. So I certainly love preferred, and for income-focused funds with degree of safety, it's a great strategy. It lacks depreciation, but at the end of the day, as a fund manager, you don't really care as much about depreciation as you care about the right investment. So
now, does it always lack depreciation? I mean, by its own nature, or is that usually just a choice of the operator?
It's conceptually, it's how it is designed, right? Depending on how the operating agreement is written, you could give preferred equity some depreciation. You can give some depreciation after common equity gets its depreciation. There's a little bit of financial engineering you can do. We happen to choose structures where preferred equity doesn't get any, but it doesn't prevent you to have a structure where preferred gets 5% or 10%. Yeah. You could certainly do something like that.
Yeah. I just want to say on your show right now, you were way ahead of me on this. I mean, your fund has been, you've been talking to me for years about preferred equity, and I just kind of ignored you. But I'm coming around, my friend. I think you're right.
Well, the world is old, right? These ideas have been around. So I don't claim to have invented them. I just happen to like certain ideas that have been utilized in the past, and we've structured our funds, for example, Tempo Growth Fund 2, and some of our recent syndications that way, the Michigan 2 deal, and then the one that's coming up, Oak Park and Stephenson House. And the reason it works is because I studied sort of our investors, and I understand what they want, and we're trying to give them what they want. There are different needs out there, and there are folks that want higher safety, and they want cash flow. Right? For those folks, preferred equity is music to their ears. And there are folks who are real estate professionals or not real estate professionals, but they have sold appreciated real estate and they need depreciation to offset that. The folks who need depreciation, they want a lot of it, and they're willing to take on more risk of being in the common equity position versus the preferred. It's a trade-off. It's not a perfect world. You either get higher safety, cash flow, or you get more upside, higher risk, and tax benefits. And you get to pick and choose. And the crazy part, you can do both. You can actually do both. You could say, hey, I am investing $1 million, but I'm only taking $200,000 position in the common and $800,000 in preferred. Right. So that ability to control where you invest in is what I love when we put these deals together. Of course, it's not a perfect structure, but it gives a little bit more choices to folks that participate.
Yeah.
So let's continue. What are you seeing in this market? Obviously, the market is volatile. The rates are still climbing. There's some fresh hopes that the Fed will lighten up, but they haven't indicated that. Although the bond market and the stock market, we're pretty happy with yesterday's data that came out in inflation. Although we don't know exactly what's going to happen in the upcoming days and weeks.
I mean, so inflation's dropped officially at least about 1%. So the news is 7.7, but that's obviously far above their target of 2. So it sounds to me like they'll probably continue to raise at, I mean, if I had to guess, likely about the same clip as they have been until they get it down at least, to maybe half of where it is now. What do you think?
Well, crystal ball question.
Yeah.
Crystal ball broke, can't find that on sale. I've said that many times.
I know.
But the thought process is the next raise will be 50 basis points, not 75. And I could be wrong. It could be 75. We don't know. But at least this report is giving them a little bit more ammunition to say maybe the next increase is 50 basis points. And if it continues, maybe the following one could actually be 25. I mean, they may be slowing down as they start seeing data improving. And we don't know how much changes they need to see to take the foot off the pedal completely. But they need to, if they're seeing the right changes in the right direction, they'll probably be a little bit more dovish versus hawkish. Right now, they're extremely hawkish.
Yeah, that's for sure.
So,
they've come a long way from saying it was transitory just a year ago last month. Six of the, I think 80%, 60 to 80% of the people on the Federal Reserve Board thought they wouldn't need to raise rates. I don't understand that when we could see it. I don't mean just you and me, the public could see it.
Yeah, that's the most disturbing and a fascinating part. And the word fascinating, using the words of Mr. Spock, this is fascinating.
Yes. Yeah.
It is unfortunate that you can call them they sleep in the wheel. They're incredibly bright people. Most of them are unfortunately closer to being economists rather than practical investors.
Yeah.
Although Jay Powell have been through the private equity, and he's been a very successful private equity investor. But taking a step back, I think they're going back for years of from Greenspan to Bernanke to Janet Yellen to Jay Powell. They've expected to see asset inflation, but not CPI, not the consumer price inflation, which they really couldn't tolerate. And it's kind of was almost a shock and surprise to them that the consumer inflation was going to shoot through the roof so fast. It was the signs were there, but they were sleeping in the wheel. I don't know how else to put it. They could have started a whole lot earlier, but they didn't. So when they woke up, they said, "Wait a minute, we got a big problem on our hands. This CPI is out of control," and that's why they started very aggressively. But it's fascinating that the fact that they should have seen it coming, but they didn't, and that's the amazing part. These brightest folks, we believe who has the most power in the world? You would think U.S. president. I think it's the Fed chair.
Yeah,
because they control the rates and the liquidity and the money supply.
Yeah, it sure
the
seems
power
like
they
it.
control is immensely bigger than the president of the United States. So they have a lot of responsibility, a lot of power, and somehow they miss the timing. And it happens again and again.
Yeah, I got to hear Jeremy Siegel speak in person in Kansas City recently. A brilliant economist, and I wasn't tracking him the last 2 years, to be fair. But if I took his comments accurately, he was apparently screaming at them a year and a half ago, at least, maybe two, to raise the rates a little to try to curb this. I don't know that would have fixed it, but he thinks that if they would have acted a year earlier, they could have avoided a lot of this. I don't know.
The gradual changes, like in that movie, Too Fast and Too Furious, right? That's what they must have watched that movie. So when they decided to go forward, they went fast and furious, changing the rates fast and at a very unprecedented clip.
Yeah.
But they should have started away earlier, and I think they've realized that if they don't do it fast and aggressive, they're going to have problems for many years. So they're trying to chop inflation at the knees rather quickly.
Yeah.
But the crazy part, they don't even understand the impact. The rate changes. The Fed policy has long and variable legs, as in the words of in the book. I'll get back to the book in a minute, but
I'm not sure which one you're referring to.
No, I'll tell you in a second which book.
You're better read than me, probably.
Yeah, it's a phenomenal book. It's called "The Lords of Easy Money." That's a very.
I don't know about that.
Yeah, it's a great book about the Federal Reserve, and I've read it a couple of times now, and I can tell you that they don't know exact impact. That's the long and variable lags. Just means that it takes a while for the action to kick into the economy, and the impact is clear. And that's the challenge. The layoffs just been announced in Meta, for example, could have been from the rate changes they started 6 months ago. We don't know that.
Well, I mean, let's look at this. Meta went above $1 trillion in total cap, and it's now, last I checked, last week, it was down to 256 billion from $1 trillion. So they have their own set of problems.
Well, that's the asset bubble. That's the asset bubble they call with very low interest rates. I mean, that has always been the issue, that these very low interest rates encourage nothing but speculation. So a lot of investors written their checks into the speculative issues.
At the same time, Amazon drops a good bit and Apple dropped very little relative to them. So I will say Meta, Facebook, I think that they've certainly got their own set of problems that are unique to them. But here's a question I want to pose. We talked about 11,000 layoffs in Sacramento. What about the 11 million job openings in America right now? 11 million. Mike, if you could lay off 11 million people, and let's just theoretically say it was really fluid, and those 11 million could go out and get another job tomorrow, is there any net gain to the Fed's efforts? I would say, at least in that one regard, no. How's that going to get fixed?
Well, you bring a great point. You can't fix the inflation without fixing the unemployment. And then unemployment is not a problem. It's a great problem to have, right?
Right.
Employment. Unfortunately, inflation will be sticky and it will be persistent.
Yeah.
Unless unemployment rate climbs, and you can't solve unemployment rate if you have so many opening positions. But it will gradually trickle through the system. That's how it works. You want to start seeing layoffs, which basically theoretically increase unemployment rate a little bit, and those folks go find another job. But at least that's a start of a gradual aggregate reduction of number of positions that are open out there. If you think about this, right? Companies that are laying off people will probably stop any new hires. There'll be a hiring freeze. They'll clear out the excess labor that they have. And then those companies that's still in dire need of hiring might absorb at least portion of those who have been laid off. The U.S., the 10 million opening jobs problem has been driven by a few factors. One, weak immigration over the last few years. Part of it, COVID, right? During COVID, we've had a lot less immigration. The U.S. needs a lot more immigration. That's one of the issues, both skilled labor as well as some of the entry level. So you can't really solve that problem without cooling the economy. More layoffs eventually will create higher unemployment numbers. But you're right from the point of view that opening jobs will be absorbing folks that come off the corporate payroll in Meta, and they're going to go possibly for, I don't know, Google, who needs more folks. But the concept is still the same. You have to force more layoffs, and then some companies that have opening jobs may come to the decision that things are not running just as well, and they may start closing some of those positions. Right. But that's the intention of this whole exercise.
Yeah. Part of the problem too is, there's this, I don't know what it's called, I'll get it wrong, the great departure or whatever. There's so many people who have retired or just quit working or not looking for work right now. I mean, there's a lot of millennials even, and Gen, I don't know about Gen Z, but there's a lot of people in the 20s to 40s and 50s who are not even working or looking for work. I don't totally get that. I mean, I know part of it's been the government subsidies that have run out, but my goodness, I mean, if there's millions of people who are able-bodied sitting at home, that's got to be part of the problem too. And of course, immigration could partly solve that, as you said. Not giving them government subsidies would be another solution. Not sure what else.
Yeah, you're touching on a fundamental desire to work problem, right? You got, and the other issue is number of folks who have chosen to retire early. They could still be working, but they made the decision that they don't want to go back to work, because once you disconnect from it's psychological, right? You disconnected from working, and now you're home, and if you have enough, I guess, dollars saved and you feel comfortable, if there's no pressure for you to go to work because you can't feed your kids, then you may choose not to work, right? It's kind of one of these things where, generally speaking, getting back to the immigration, you need to feel the hunger. You need to feel the need. You come to America to work to make a living to be successful.
Yeah.
Right? If you that this is the classic traditional way. And if you are an immigrant coming over, we're going to take care of you, you don't have to do any work. As you can imagine, people can choose, hey, I'm going to be enjoying life without spending the time working. And that's a fundamental concern, a fundamental problem. People don't want to work for the reasons that maybe they retiring early, and or maybe it's the helicopter money that they've received.
Yeah.
It's hard to get
or their spouse is working.
Yeah, but at the end of the day, when the pain is severe, people go back to work.
Yeah,
they need a lot more pain to be caused in the economy, a lot more layoffs, a lot more.
Yeah.
Then people start making those decisions, not out of a nice life, but out of a necessity that they need to work to pay the bills. That's kind of the way to think about it.
I've got an idea, guys. If you don't want to work, marry a traveling nurse. Have you heard about that? I heard about it. I talked to a doctor the other day who said he was in Tampa. A whole bunch of nurses were so frustrated by COVID, and he explained how horrible it was. A lot of them had to play hospice nurse. They were ER nurses or they were critical care nurses, and they had to be there holding the hand of this dying patient because their family couldn't get in during COVID. And they had to do FaceTimes on their phone with this person and the family weeping in the parking lot as this person was dying. And it took a huge toll on them. So a bunch of them quit in Tampa, and a bunch of them quit in Orlando, an hour and a half, I think, away. And now they're traveling nurses at the other place, costing the hospital system double or whatever it would have cost if they would have stayed in their jobs. He said this is a massive problem that can't quickly be fixed, and that's adding to this whole mess.
Yeah, if I understood you correctly, the traveling nurses get paid more working somewhere else than in their own neck of the woods.
Yes, a lot.
Well, that's adding fuel to the inflation fire. So
yes, that's right.
There's dislocation of supply and demand.
Yes,
for labor, and it's not going to get solved anytime soon.
No.
So that's the reason. That's the concern that the Fed may not, although people hope that they're going to slow down, but they may continue to push the rates up until they start seeing a lot more layoffs, and that's I think we need to definitely improve immigration policy. We definitely need more immigrants. This country was built on immigrants. I was an immigrant, and I can tell you, bringing folks in with a desire to work is going to alleviate some of the pressure. Yeah, no doubt. And on a forward basis, I think it's pretty clear that the government fiscal policy is not going to be very inflationary. They're not going to be spending a ton of money. The COVID crisis is sort of over. The composition, these midterm elections have changed the composition of the House, at least, right? We don't know the final numbers yet. Yeah. We're recording this in November 11th, but we don't have the final numbers. But it's pretty clear that at least it's going to be restraint on that. And then the rest, the economy just needs to cool down by itself and let the government stay out of the business, right? The last regulation, the split government will probably be good for business in general. Let the business run its course, and the Fed action will cool down the economy. And we just hope it's going to be sooner rather than later. Yes. By the way, the reason they're pushing the rates fast and furious is they cannot afford to do it slow. They just cannot afford. Yeah, because I heard, I don't have the exact numbers, but it'll cost the U.S. government like an extra $1 trillion if they don't get this rate up and then back down very quickly. Yeah, it's not just the U.S. Government. You have the public debt, the private debt. Unimaginable. The private debt is a humongous problem. A lot of corporations are essentially now they're zombie companies. If they had to refinance their bonds now, they wouldn't have enough cash flow to service the debt. Yeah, and that's a pretty bad position to be in. The U.S. economy is leveraged with so much debt that I think if we don't get the rates back down, the refi cycle will be detrimental to investors.
I just saw a stat that said 23% of CMBS will be essentially CMBS debt will be essentially unrefinanceable in the coming couple of years.
If the rates don't come back down, yes, correct.
Yep. Right.
Yeah, it's alarming. You look at some of the rates today versus what they were a year ago, right? I mean, just a year ago, the rates have gone up so much. In many cases, more than doubled for what was available. That if you had to suddenly refinance, you're in deep trouble. Absolutely in deep trouble today. And that's the need, is to cool down the economy fast and get unemployment higher, get inflation a little bit more under control, and then they're going to have to probably start pushing the rates down. The big question is going to be this: Are they going to get hit with some kind of a crisis, or it's just going to be gradual? If they get hit with a crisis, they're going to have to move fast.
Yeah.
So we don't know this, but at this point.
Right.
So any new opportunities beyond to invest beyond the first lien debt? Anything interesting? Anything and preferred equity? What else are you thinking about?
I mean, you and I have talked about this before, but I'm really interested in continuing to understand and look at more RV parks. There's at least three major types of RV parks out there. That's the overnight, which is kind of on the way somewhere. There's the long-term stays, like at a lake, where people put a deck around their RV and they stay there year round, or for usually for decades. And then there's the third type, which is destination RV parks, which have like a water park and slides and playground and movie screens and literally 50 other things, fishing lakes and swimming pools and $2 to $3 million water park added. All those things. We really like these asset classes. The supply and demand is way, way out of whack, especially when you consider outdoorsy and RV share, which allow people to turn their RV into a rolling rental unit. Now, instead of sitting idle 350 days a year, they might be able to rent them out, 100, 200 of those days. I know somebody, you and I both know, is the same person who has rented her RV for 6 months of this last 12 and made $40,000 net cash flow on an $80,000 investment in 6 months. And so pretty impressive asset class, something I want to invest more in. I'm looking for operators who have, a decade or more of experience, and I'm not finding them.
Yeah, and that's the biggest challenge. The concept makes sense. I certainly love the idea, and we would love to invest in the RV park. We talked about this. We get the right operator who you have both great experience and also institutional quality terms.
Right.
You either get the sort of the newer folks, and they'll agree to any terms you want because they want to try it, which you don't want to invest with them.
Right.
Or you have great operators and they've established pretty strong presence. And again, the deal flow is limited too. So it's not like this type of deal flow is readily available. But strategy does make sense if you can find great operators and great deals.
Yeah. And I'm also thinking about outdoor industrial storage, which again, I don't know that either one of us have any great lines on, but it seems to me that there's a huge need for this right now. Companies looking for 10 or 20,000 square feet on a, just a place to park vehicles, keep pallets of roofing supplies, hold piping, things like that, lumber, etc. when they get a good deal. Would love to find a great operator in that class as well.
Yeah, I appreciate sharing. If you find a great one, let's keep chatting. But it comes down to like anything else in real estate, comes down to a great operator and location and the asset. So if you can find a great deal, let's certainly join forces. Anyway, it was a great episode. Appreciate your wisdom. If folks wanted to reach out, learn more about your new fund, how would they get a hold of you?
They can just come to us at our website, Wellings, WELLINGS, wellingscapital.com.
Thank you, Paul, for your wisdom. Thank you for coming on the podcast.
Thanks, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.